Hello and welcome to our regular quarterly market update where we share with you the key market events for the fourth quarter of 2023. I'm Simeon Willis and I'll be guiding you through the ups and downs of the financial markets with my colleague Dan Carpenter, who's an investment partner based in our Guildford office. Between us, we're going to talk you through what turned out to be a very eventful period that turned the tables on 2023 as a whole. There was a lot going on with interest rates, inflation and equity markets. So we're going to start by taking a look over the pond at the US. Dan, can you tell us what's been going on with interest rates?
Thanks, Simeon. Now, the different messaging from central banks at the end of last year was quite interesting, particularly the changing approach by the Federal Reserve. The fourth quarter began with the Fed warning that interest rates would remain higher for longer as it looked to control and bring down inflation. However, by the final Fed meeting of the year in December, Chairman Powell had declared that the benchmark rate was, in his words, likely at or near its peak for this tightening cycle. Now, I think it's fair to say that this was an acknowledgement from the Fed that growth had slowed from its strong pace in the third quarter, plus a recognition that inflation has eased over the past year. Now, I'm mindful that this is quite a shift in tone in messaging from the Fed and took many by surprise with this shift in outlook and a move from a focus to controlling inflation to stimulating economic growth over the space of just a few months. To put some context on this, interest rate swap markets are now pricing in 6 interest rate cuts by the Fed in 2024, compared with just 3 at the beginning of the fourth quarter. It's this dovish shift from the Federal Reserve which has sparked a rally for US stock markets and also sent US Treasury yields tumbling towards the end of the quarter.
A bit closer to home in Europe, the common inflation measure, the Harmonised Index of Consumer Prices, fell to 2.4% by November, almost 2% lower than at the start of the quarter. But the European Central Bank maintained its benchmark deposit rate at a record high of 4% in December. The Bank of England stuck to its official lines in messaging to the market that there remains a long way to go to get inflation back to its target, despite some mixed messages from Hugh Pill, chief economist, in November around scope for possible rate reductions in 2024. The UK Consumer Price Index fell faster than expected from 6.7% to 3.9% between September and November. But the Bank of England Governor Andrew Bailey has left the door open to further rate rises if necessary and expects interest rates to be kept high for an extended period of time. Now, we've become quite accustomed to base rate rises tracking changes in gilt yields, which in the most part has been very positive for pension scheme funding levels over the last 2 years. However, it's worth reminding ourselves that long-dated gilt yields are very different from short-dated interest rates. And whilst the expectation is for short-dated interest rates to remain at current levels for some time, there's considerable scope for gilt yields to move in either direction. We've witnessed this in the last 2 months of the year with sharp falls in gilt yields. Now let's move on, and Dan, can you talk us through the returns across the different asset classes?
The fourth quarter was a healthy quarter for markets with strong positive returns across the board as shown by the chart. Starting with equities, despite mixed messaging from the central banks over the quarter, as we discussed earlier, global equity markets performed strongly, experiencing a quarterly return of 6.3%. UK equities were also positive, but lagged with a return of 3.2%, having faced stronger inflationary headwinds than most major developed economies. Emerging markets, heavily reliant on the performance of China, were positive, but lagged other developed markets. China has seen significant outflows of foreign investment over the last year due to a combination of a wobbling real estate sector and falling consumer and business confidence. Turning to bonds, UK corporate bonds enjoyed a particularly strong quarter, a return of 8.2%, due to the combination of falling interest rates and tightening credit spreads. Global high-yield bonds, highly sensitive to expectations of future borrowing costs in the US, benefited from growing expectations of significant interest rate cuts in 2024. And finally, due to gilt yields falling dramatically over November and December, both fixed interest and index-linked gilts rallied strongly with a double-digit quarterly return in the case of fixed interest gilts.
Politics looks set to dominate in 2024, with more than half the people in the world living in the 70 countries that are likely to be going to the polls this year. This includes the UK, where the very latest date for a general election is the 28th of January 2025. In terms of economic impact, there are numerous unpredictable ways this could affect markets. We'll have to wait and see what unfolds on that in the coming months. But in terms of pensions investment in the UK, the parties seem broadly aligned in some of the key areas, with Labour's position on the Mansion House reforms looking broadly consistent with the Conservatives, albeit with a greater apparent drive towards investing in the UK. Continuity of approach for this sort of long-term policy making will be beneficial all round. Now let's take a look at how pension scheme funding levels have changed.
Over the quarter, the aggregate UK pension scheme funding on a low-risk basis fell by in the region of 5%, as liabilities grew by more than assets. As we discussed earlier, this was driven by gilt yields falling dramatically over November and December, which significantly increased the value of scheme liabilities, although this was partially offset by falling long-term inflation expectations. Now, it's important to highlight that pension scheme funding continues to remain very healthy in aggregate, given the wider trend experienced since the gilts crisis. Over the quarter, individual schemes are likely to have experienced drastically different outcomes from the gilt market rally, depending on the extent to which their liabilities are hedged.
Thanks, Dan. So moving on, climate change remains a key area. Can you share what we've been seeing here recently?
Yes, the 28th Climate Change Conference Summit drew to a close in the United Arab Emirates in December. A first global agreement was reached to transition away from fossil fuels. However, I think it's fair to say that it did fall short of what many hoped would be a more robust agreement to phase out fossil fuels. Other pledges were made to treble renewable energy capacity, increase investment in carbon capture, and cut methane emissions. Now, the statement in relation to transitioning away from fossil fuels is quite historic, as it represents the first recognition by all parties that fossil fuels have no place in the future energy mix, and this should represent a turning point away from their extraction and use. The outcomes of COP will have significant implications for economies and financial markets, with not all countries needing to decarbonise at the same rate in the pathway to 1.5 degrees. Now, linked to this, we've recently carried out some analysis on the back of reviewing all readily available TCFD reports that the larger pension schemes have been mandated to produce. And two key highlights from this study really stood out for me. Firstly, only 60% of schemes had set a net zero target, with only a smaller proportion having a clear plan as how to achieve this objective. Secondly, as part of the analysis, we reviewed the implied temperature rise reported by schemes and calculated a weighted average of 2.8 degrees, which, it's fair to say, is miles off that required target of 1.5 degrees, and therefore really indicates that many schemes are holding assets which are misaligned with that climate transition.
Thanks, Dan. Now, as usual, we'll end on our outlook with a number of changes in our forward-looking views. On developed market equities, we've upgraded our view to favourable. Whilst equities have experienced a good run in the last couple of months, we think the scope for non-US developed markets in particular to make up some ground. For emerging markets, we remain neutral, reflecting that valuations remain attractive in some areas, but political risks remain elevated given the number of elections in emerging markets and the continued challenges in China. Investment grade credit remains neutral, but we've downgraded high yield to unfavourable, given that spreads are now below long-term averages and the higher financing costs place high-yield companies at greater financing risk. Secure income and direct lending have been moved from favourable to neutral, reflecting lower expected yields, albeit good levels of security. And diversified private markets are now neutral overall, but we know the existence of opportunities in a number of subsectors. Both long lease and balanced property are neutral, reflecting a mixed bag of opportunities and risks, combined with some funds being closed to redemptions. And buy-in looks more neutrally priced now compared to 12 months ago. Cash remains favourable, given that it's currently yielding more than medium and long-dated bonds. Now, there was quite a lot there. I hope it's given you a flavour of what's been going on. If you'd like to find out more, please see our website or get in touch with your usual XPS consultant. And that leaves it for me and Dan to wish you a happy new year.